I'm Michael Fox, and this is the Prospector News Podcast. And joining me, I have the National Investors editor and publisher, Chris Temple. Welcome back, Chris.
Hey, always glad to be back, Mike. How's your summer going?
My summer is good. Where in the world are you? You're having like the Temple World Tour.
Yeah, I don't know about that, but every summer we come up to Wisconsin and spend as much time as we can, visit the kids and the grandkids, and theoretically get away from the heat. Though since we got here last Saturday, it's been darn near as hot during the days it's been in Florida, and we actually had 106-degree heat factor yesterday at one point late in the afternoon before some storms came through and took some of the edge off of that. And now it's going to be a bit more to our liking, upper 70s, low 80s for the next several days, at least by the present forecast. So that'll be more fun.
Yeah, I can handle heat. I'm a large mammal though, and I don't like humidity very much. That's what'll set me back on my tail in a hurry. Um, we've had a pretty sticky summer here too. It's not been overly pleasant for my liking. I like the last couple where it was just hot and not humid. So, but that's the way it goes. We can't always get what we want. Then we could say the same thing about the Fed. The Fed raised interest rates again this week, another quarter point, and talk tough. They want the market to pay attention, but the market seems to be ignoring them again.
Well, it is, the MO of stock traders and most money managers has been when almost every meeting, especially now that they're going to go meeting to meeting, before they make a decision, every meeting, every data point between meetings is a Rorschach test. If your propensity is to be bullish and want to believe that the Fed is done, well, you got something to hang your hat on. If your reason for living is to be bearish and think that it's time to be shorting or past time to be shorting the stock market and so forth, you can find stuff in what the Fed says and does there as well. Most everybody is of the belief that now that the inflation numbers, which went up for a long time to their peak last summer, have been declining since then, that there is not going to be any reversal to that. And I think in the months to come, and we're not going to have to go through very many of them, they're going to be proven very wrong, as will the current assumptions that a lot of people are making on just about every asset class.
Yeah, I'm looking at that, and we've seemed to have gotten into a world where inflation is now representative in two factors. There's the CPI, which has come down, but there's still food and shelter inflation, and that's still trucking along at very high levels. But they don't seem to factor that into the CPI at all. And until the basics start to even out so that people aren't losing their disposable income to keeping a roof over their head and food on their table, I don't see where the Fed can stop.
I don't think they're going to. They may or may not skip another meeting or two, but I think that, as I've said to you a number of times, this is going to be a slow, dull ache. We are going to see inflation come back up, maybe not to the level it was at the middle of last year, but it's not going to be going down any longer. We've had crude oil prices up 5 weeks in a row. That is going to start to be felt maybe as early as the August CPI headline number. If not, then certainly by September. We've got we're 7%, I think, below gasoline stockpiles. The 7% below the 5-year average, I believe, is what Phil Flynn reported the other day. So there's a lot of reasons between that. You've got new upward pressure on a lot of the grains. There's going to be more upward pressure generally on prices. And part of that reason is because after all this time, and of the Fed raising interest rates now 525 basis points and counting, what have you got? You've got an unemployment rate identical to what it was when they started this whole thing. And the economy, which at least the Fed staff earlier this year said we'll probably be in at least a mild recession by the end of the year. Now they've even backed off of that, which Powell pointed out in his press conference on Wednesday. So there is likely to be no recession beginning at least this year. I mean, the Fed itself and all of the numbers and gobbledygook they put out at the beginning of the year, they said growth was going to be 1% for the whole year. Well, if that's the case, it's going to have to slow down in a hell of a hurry over the next 2 quarters, because the initial number for Q2 just came out at 2.4. So, you know, and that's on top of a decent report as well for the first quarter. So there is still so much liquidity, so much traction that the markets all have, and that the economy has, from all of the money printing before, et cetera, that, you know, this is not going to slow down easily on its own. Yes, and eventually you will see the lag effects, as they call it, of these rate hikes start to bite a bit more, but we're not quite there. And so, you know, as always, Wall Street wants the best side and the rosiest side of everything, to look through the rose-colored glasses and find reasons to keep chasing the stock market rally. But look, these things are not going to be able to coexist much longer. You're either going to see a more notable slowdown in economic growth across the board, rather than the spotty stuff that we've had, or you've got to brace yourself for another 1 or 2 or 3, whatever Fed rate hikes, until they're happy with the trajectory of things. And the biggest risk right now to the markets overall, Mike, is that nobody is factoring into their calculations a move back higher, even a modest one, in inflation, and the possibility that the Fed continues to do this, maybe even into early next year, of all things.
Well, there's a number of things to unpack there. You know, tongue firmly in cheek, I think we have seen the first sign of as possibility of a scary recession, because Jim Cramer came out last week and said, I see no signs of a recession. So that's, you know, there's the kiss of death on that particular
eventually
element. But I'm looking at the unemployment numbers, and the unemployment numbers themselves have some degree of backwardation to them. Someone who gets laid off in January, February, and March, and there were a lot of layoffs in the economy during that period of time, they all got severance packages. Now, you know, depending on the length and time, those severance packages, as we head in further and further into the fall, are going to start to run out. And unless those people have found new employment in the interim, and you know, the jobs numbers have been okay, but they haven't been, you know, earth-shatteringly large enough to suggest that these people, you know, have fallen out of one job and landed right back into another. Some of those numbers are going to start to show up in those unemployment numbers in the fall, and we could see unemployment starting to tick up again as people start to actually go on the unemployment rolls, because they don't reflect people that have been laid off and not on the unemployment roll. So, you know, there's that bit of a challenge going forward. Same with the interest rates biting into the mortgage markets. We're starting to see that now, in that housing starts were down last month. Applications for new mortgages were down. Those are starting to bite into the economy. But until people have to renew their mortgages and are faced with a very large interest rate hike, they can kind of sort of stay where they are and hope for the best and pray that the interest rates come back down before they have to renew. But at some point, you know, just like, you know, in a down market, there's going to be margin calls. There's potentially, you know, the mortgage equivalent of margin calls coming to the housing market at some point.
Well, that's right. And look, as I said a bit ago, there is no question that we will start to feel, as time goes on, some of the lag effects of what the Fed has done to date. And nobody questions that. The only question is timing. It certainly hasn't occurred as quickly as most would. There are some signs of that, as you've pointed out. You know, weekly jobless claims have gone back down on the one hand, But I think that that's a bit of a misnomer as well. I think overall there is some softening going forward. It's going to be more important, Mike. I think even as the number of new jobs softens a bit, maybe unemployment ticks up a little bit. What are the wage numbers going forward? Because that's the one, for better or worse, that forever the Fed has been fixated on. They threw away the Phillips curve once upon a time. Now they've re-embraced it. The Phillips curve, for those that don't know what I mean by that and don't want to go look it up, is essentially the Hobson's choice, if you will, of if you have higher wages, the Fed needs to stop that because it's a bad thing for the economy, because that feeds inflation. We went through a period of time finally for a while where the Fed was starting to back away from that and not automatically believe that strong jobs numbers and more so strong wages were a bad thing because there were other disinflationary things out there that were helping. Well, now we don't have that anymore. And so the Fed is not going to want to see wage gains going forward, which is why all of the news recently about major unions getting major concessions on wages and stuff is another thing that's going to be a fly in the Fed's ointment.
I heard anecdotally, and I haven't had that, but did UPS just settle for like a 40% wage increase or something ridiculous?
I've seen a couple of reports on it. That depends on how you want to crunch the particular numbers, but the very lowest wage for anybody at UPS is going to be $21 an hour. And yes, I've seen numbers in the 30s at least as far as what the overall wage increase is going to be. That's on top of a similar one back last month that FedEx pilots got. We have, as I think you and I talked about the last time we spoke, the United Auto Workers in negotiations with the Ford, GM, and Stellantis, and they want more money. So here again, and this is going to be interesting. The Fed, for a long time, contrary to what everybody else could see plainly in front of our face, insisted, as we all infamously know, that inflation was transitory, that it was here just briefly, but it's all Putin's fault, or it's all the fault of COVID and supply chains or whatever, while the Fed itself was the primary cause of this. Well, they finally had to admit that they were wrong, that inflation was not transitory. But similarly, is one component of that is that Powell has said, and I didn't hear him say anything differently Wednesday afternoon, that what is now maybe transitory or isn't going to matter at all is his view that there is not going to be a wage price spiral as we had in the 70s. Now, in those days, you had a much larger percentage of the working public that belonged to a union. The unions had a lot more power. Maybe you've got less union membership today in the US, but even for people who aren't union members, it has very much been a labor market when it comes to negotiating wages and price increases. We've seen across the board, even for fast food joints, that the federal minimum wage, which hasn't been raised in years and which is laughable, you make double that starting out at McDonald's, or maybe more than double starting out at Starbucks. So there has been more wage gains. They still don't really keep up with inflation for the average household, which is all the more reason why they're pushing for more. And when you've got a labor pool which has shrunk somewhat, and a lot of people that are retired or don't want to work or whatever, or in some industries you've got a shortage of skilled labor, across the board, businesses are paying up. So I got news for Fire Marshal Jay. We do have already a wage price spiral, and it's going to get worse.
I agree. You almost do a reverse Kramer every time the Fed says transitory, it's going to be permanent.
Pretty much.
But and that's not even talking about, energy prices. Energy prices have been ticking upward here since the early part of July as well. And, as energy goes through literally every single part of the economy. And, that's gonna bring inflation back in in a broad sense. You know, here on Prince Edward Island, we just had a 7.2 cent a liter increase in our gasoline prices this week because of higher oil prices and our idiot prime minister taxing energy.
Yep. Well, here in the US, most of what I've seen in the recent past, we're up between 8 and 10% on gasoline since the start of the summer.
Yeah.
And all signs point to prices are going to rise more. And you know, the crude oil market, and I'm very, very bullish on old energy, whether it's crude oil or natural gas. A lot of the different stocks we just added to those holdings this week, more than what we already had. And I'm going to be doing more of that in the coming days and weeks. But this is a prime example of how different markets right now are responding radically different to the same economic statistics out there. And it's because you've got traders that act as this one mass for the most part, who get it in their head that, well, such and such a set of reasons means that the Fed is not going to raise interest rates any longer. Interest rates in the dollar have peaked. And so now we can be throwing even more money at AI stocks and the NASDAQ and stuff like that. But we don't like oil. Well, those two things don't go together. Because if you believe the Fed is done raising interest rates, if you believe the dollar has peaked, if you believe we're going to skirt a recession or at worst have a mild one, maybe sometime next year, then you should be buying oil because the demand is not going to shrink that much. But everybody got it in their head, and this was the theme among oil traders for a while, when you had a bit of a rebound in the dollar, and China has, as we all know, has had an anemic economy this year. People have focused just on things like that without looking at the fact that the long-term picture of the supply deficit for energy based on every year going forward, record demand every year. This just doesn't add up. Even if you think the economy was going to go into a mild recession right now, and looking at the costs and stuff like that, oil should at least be in the mid 80s a barrel US, if not higher. And it's not. So I think that there's a great opportunity there. And the same is true to different extents with the way the markets are behaving where other commodities are concerned.
You put out a very good piece yesterday with 5 reasons why the market is not pricing in what the Fed is saying and doing properly. Did you want to touch on
Yeah, I
those
want to
5
go
points?
through those. I want to go through those quickly. If nobody saw this, shoot me an email, chris@nationalinvestor.com. I'll forward this to you and some related stuff that goes into more detail. But look, I just pretty much put out the 5 reasons why, even after this 25 basis point this week, I do not believe that the Fed is going to be done tightening. They are basically number one, and we've alluded to a couple of these things along the line. You know, the fact that we don't have a recession, there is not one on the immediate horizon. The Fed has boosted, and the Fed staff especially have boosted their economic outlook. And in his press conference Wednesday, Powell reiterated that, yeah, that's a wonderful thing. We're happy to see that. But don't forget, as I've said all along, that we're going to have a period of subpar economic growth in order to finish the job of bringing inflation down. We haven't had any of that yet. So you're going to have to see maybe a couple or 3 quarters, depending on the severity, whatever, before, maybe the Fed along that way will stop raising rates, but before they even think of lowering them again, under the best case, you're going to have to see a couple or 3 quarters of subpar economic activity, or maybe even a technical recession. This quarter's, growth and that for the first half of the year, little over 2%. That to the Fed is trend growth. That's the normal speed of GDP growth that they expect for the economy. No stretching of, a Pollyanna type attitude toward, la la land and this Goldilocks scenario. Anything, Mike, changes the fact that the Fed doesn't want to see that number, because when it sees that number, it knows that it's still got work to do. So that's number one. The economy is still growing faster, and everybody at the Fed understands and believes that because the economy is still growing faster, they can raise rates maybe a couple of more times to finish the job without doing any major damage. That's number one. Number two, core inflation is still well above 4%, whichever measure you want to look at it, including this morning as we're recording this on Friday, the core PCE number. We've probably seen all the help we're going to get from that. And so not only might core inflation tick up, headline inflation rates, which have been lower than that for several months now, are probably going to start playing catch up, if not go higher, especially if food and fuel, as I expect, generally speaking, especially with fuel, continue to trend higher for the balance of the year. So core inflation is not going to come down enough sufficiently in the near term to stop the Fed. Number three, the job market, as I've said, is still strong. The Powell the other day kind of played both sides of that about how wonderful it was that we still have the same unemployment rate that we had when the Fed started. So that's a good thing. But here another but came in. Don't forget, folks, that just like we need below trend growth to finish the job, we probably are going to have to accept the fact that it's less of a price to pay to have unemployment go up some as well than it's going to be to have inflation become entrenched. So they aren't happy with the job market either. Number four, a corollary to that, as I alluded to a few minutes ago, is wage growth, and wages are continuing to go up. We are well into, I think, in fact, a new wage price spiral. That's not going to end anytime soon. And the political imperative in Washington will not allow the Fed to think that. And then finally, and this is an interesting one, Powell, when he and the other central bankers several weeks ago were gathered over in Portugal to hold forth on whatever, he was asked about stock prices and basically, asked, well, with the stock market rallying like they don't believe you, what do you think about that? Does that hurt or harm anything? And he made a comment essentially to the effect, Mike, of, well, we're not targeting stock prices. Okay. Well, here again, that's a green light to the bulls that think that the Fed is going to end up impotent and at some point is going to chicken out and stop raising rates. So stock prices in the broader context of financial conditions are likewise making the Fed's job harder. Early on, at least, Powell was more forceful in discussing those things. But financial conditions have still been very lax, more than you would have expected by now. Consumer spending is still fairly strong. Yes, to some extent, as people add on more debt, but they've been able to do it. So financial conditions are also just like GDP growth, and the two obviously go together to some extent. They are not telling you the story that we're going to have a recession or that the Fed is done. And the financial conditions thing, though, may just have been changed by something the Bank of Japan did. And as much as anything going forward, that's going to bear watching.
Yeah, I was gonna say, like yesterday, it looked like, and it was small by market, terms, but the market seemed to throw a small bit of a tantrum yesterday, and I was thinking just on the surface that it appeared, maybe the Fed was starting to sink into people that they really mean it this time. But then you take a look at what the Bank of Japan did and realize that was probably the reason for the little tantrum.
I have been reporting on this for the last several months as to one of the reasons why the Fed, for all of its tightening and trying to unwind its balance sheet and so forth, has not seen that much result yet, and which we've been talking about, of course, along the way. And one of the key reasons is that, and I had my cartoonist Jerry King do a cartoon. Some of the people listening may have seen this, of Dr. Doolittle's Push Me, Pull You. Okay, where you got one end of the beast is going one direction, the other end is going the other direction. They may not be synchronized. All right. For every dollar and euro that the Fed and the European Central Bank have taken out of play, and you throw in the Bank of England and the Bank of Canada for good measure, the Bank of Japan has added liquidity in equal or greater measure for months. They have been the party that has kind of through the back door continued, even in the context of all of these central banks, quote, tightening policy. They have continued through the back door to keep the foot on the accelerator so that there is not a more abrupt withdrawal of liquidity in the world. So this is where a lot of people, just to use one example, Mike, would talk about the Treasury yield curve. Okay, the Treasury yield curve is not radically inverted only because a lot of people buying long-term bonds are betting that the Fed is going to cause a recession or stop hiking interest rates or whatever. The Treasury yield curve is inverted because for a while now, investors, speculators, currency and bond traders of all manner have been borrowing yen or shorting Japanese bonds, okay, or borrowing, pledging, however they do it, where you know that there has been a limit put on how high the Bank of Japan will allow those bonds to trade. And then they've been investing the proceeds in much higher yielding treasuries or euro debt or whatever. And so this is one of the reasons why you have an inverted yield curve, is because there's been a lot of buying at that long end, even as the Fed ostensibly is selling some of its holdings. So what just happened yesterday, and I didn't see the exact timing of this, but I was only reading some reports afterward this morning, Mike, but when the news came out that Governor Ueda, who just took over in April from long-serving Bank of Japan Governor Kuroda, he did something that the market and the press reports, and he himself, I think, said to tweak their target rate for Japanese government bonds. But what it was at least a step away from the Japanese central bank continuing to add unlimited liquidity to the markets. Now, a year or so ago, when this happened earlier under Kuroda, and for a long time, you needed a microscope to see any kind of a yield on Japanese debt. Well, then they had a situation where their position was they would buy any amount of debt necessary to keep the 10-year yield pegged at 25 basis points. When they changed it a year or so ago to 50 basis points, it took the market about 10 minutes to sell off Japanese government bonds, so that now they were, yielding 0.5%, 50 basis points, or maybe less, depending on what would go on day to day. But this whole time has been, and people have heard this term before with central banks and how they've suppressed interest rates globally for so long now, this has been like holding this big beach ball underwater. Well, what Ueda did was to say that we're going to adjust the range, and we will allow 10-year Japanese government bonds to trade either side of 50 basis points. We're only going to worry about it when the yield gets up to 1%. And then we're going to step in and make sure it doesn't go any higher than that. Okay. So that is an initial step, the effects of which we'll have to wait and see how this plays out, to see how it works out. But now all of a sudden, if you've had the inclination all this time, no matter who you are, to borrow yen and or hypothecate Japanese government debt against treasury debt, let's say, now this is no longer a risk-free game. Because if you have to buy back Japanese government debt later on to satisfy one of these carry trades, and the yields have moved higher, okay, the price is going to be lower. So there's a risk here of people being offside on this, and the money is not automatic and easy like it has been. So again, this is the first time that there's been another, a serious question put into the only major central bank on the planet that has continued to add liquidity to the globe when everybody else is trying to take it away. And maybe finally, this is going to be a sign that, all right, we're going to settle into this slow, dull ache that I've talked about all the time.
Yeah, definitely. And it's a good reminder to people that these markets are a lot more complex than most traders actually think they are. And that, it's, something in Japan can have an effect here.
Well, it can. And I mean, look, we know that markets have been global. They've been global for many decades. And a lot of times one central bank is carrying water for others or vice versa. But if finally, and look, there's a couple different schools of thought that I have and that I've read on why the timing of this, okay? Kuroda, when he left, there were political reasons. I won't get into them now for time's sake, but when he left, there had been political reasons that he was not going to stop the essentially unlimited monetary inflation in Japan to keep everything levitated over there, because that economy and their markets have been, dormant more so than the rest of the world now for 30 years, since the bubble in Japanese assets peaked in the early 1980s. So number one, okay, you wait to have the new guy settle into the job, and now you start tweaking. But the other part of this, I think, is that in concert with one another, I think Ueda wanted to wait to announce this until you had this mindset that had come into the markets that inflation in all of these other countries is fluttering down already anyway, most notably in the biggest market, the US. And so if they are going to take a step back from monetary inflation, it's going to have a less dramatic effect than it would have if inflation was still high. And so now it's a more benevolent move on Japan's part, which they can get away with based on the lowered recent inflation numbers, than if they had done this when inflation was still raging and everybody really seizes on it and says, oh my God, now Japan's got to fight inflation too. Which they do, because for a while now, Japan's inflation has been 3 or 4%, which proportional to their pitifully low interest rates is worse than what we've had.
It's there, but 1% compared to what 5.25% now in the US, it's still a pittance comparatively.
Well, it is, but it's not going to stay that way. And again, we don't know how quickly all this is going to play out, how quickly it's going to have an impact on the markets overall. But this is, to anybody who understands the dynamics of these international markets and understands that the Bank of Japan has been one of the biggest reasons why the tightening elsewhere has not yet had the traction expected. You just had a shot fired across the bow that, okay, that door is going to start to close.
Yeah. Looking forward, September and October always seem to be months fraught with danger and black swans and all sorts of market mayhem. Is there any sign of anything that could possibly cause us grief in those months coming forward?
Well, I'll finish up real quick. First of all, as far as the markets in the US generally, I don't think so. Again, this whole thing of the US economy slowing down more broadly, the markets finally recognizing the longer term dynamics, this is going to continue to play out over an aggravatingly long period of time, very likely. But two things. One is, when the point comes, I won't say if, when the point comes that we do get a few economic numbers in a row showing that inflation is starting to bubble back up, and that has an impact on rates with or without whatever Japan is going to be doing, you run the risk of a very sharp decline, especially in the stock market, because again, the overwhelming bet in the markets is that the general inflationary trend is already set in concrete. It is not going to change. And because of that, the Fed is done or about done hiking interest rates, and maybe by next year they start lowering them. When you get a few things in a row that really cast some doubt about that, you got nothing under a lot of this stock rally right now but air. And you know me, I not only don't like to make sensationalist predictions, I'm critical of those who do, that don't know what they're talking about. They're just trying to scare people. But this reminds me of the summer of 1987, when the liquidity in the market and the momentum of people chasing stocks, it didn't matter what happened. It just kept going and going and going until the end of August, when all of a sudden you had an abrupt move higher in treasury yields. And in 7 weeks' time, the stock market lost 40%. So I see a risk of that. The other thing I'm watching near term, Mike, is we're running out of time, is the Fed, and I think you and I discussed this last time as well. The Fed holds its annual summer picnic out in Jackson, Wyoming, hosted officially by the Kansas City Fed. And the theme this week or this year rather, is going to be structural changes in the global economy and what the challenges of those are to central bankers. I'm just starting to sniff the most aggressive statement in a very long time by the central banks against governments for exacerbating the inflation problem that they're trying to deal with right now. How they're going to do that, there's a few different interpretations I'll be writing about in the National Investor in the coming few days. One might be a big surprise and go against something that the Jerome Powell has also insisted on for so long. But it's going to be interesting because you have this every now and then over the years where, you know, the Fed says, well, you don't want to tread in fiscal policy, or, you know, fiscal policy is going to have to do this, when all of the politicians, they just want to keep spending money and have the Fed continue to be the enabler. There's going to be some pushback on that. I'm just interested to see what form it takes.
Definitely. So if people want to follow your musings, how would they do
go to
so?
nationalinvestor.com, or on Twitter, follow me at Nat Investor. So it's National Investor abbreviated in the national part of it. So at NAT Investor.
Perfect. Thanks for joining me, Chris, and I look forward to our next conversation.
Anytime. We'll have to send a spy to Jackson and see if we can get an embargoed agenda of what they're talking about.
That would be good to be a fly on that particular wall.
That's right. Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.